One of the more frequent mistakes I see beginners do, or even traders with some time under their belt, is using technical analysis in situations where it really shouldn't be used. One of the really obvious examples is drawing trend lines and all kinds of shenanigans on volatility instruments such as FinTwit's favorite, the VIX. There are many other less noticeable wrong use cases, which might be argued upon, like treasury yields, money market instruments, leveraged ETFs and other synthetic products, or even some exchange rates. If you ever caught yourself doing TA on any of these, you better stick around and let me explain why this is completely useless and wrong. The point here is not if technical analysis works in general, or if there is any real edge in using it. Let's go from the assumption that some use cases might exist, either be it for timing trade entry or exit, following trends, or whatever you might come up with. So if you want to use it, you should know when it makes sense and when it doesn't. To first understand why it doesn't work on certain instruments, you have to remind yourself what technical analysis is and why it's believed to work. Technical analysis assumes that price action embeds repeatable human behavior and that supply-demand dynamics are expressed through trends, momentum, and patterns. For some instruments, that assumption largely breaks down because prices are either mechanically defined, policy-driven, or dominated by exogenous variables rather than trader psychology. Do you now see where we are going with this? We will start with the VIX, and the same goes for all volatility indices. Doesn't matter if it's VIX, OVX, GVZ, the MOVE index, or anything else, pretty much the same problem lies behind all of them. First of all, they are not tradable assets. They are mathematical calculations derived from option prices. You might draw a large time frame support level on the chart, and at first it will look as if the price action is respecting it religiously. So you think to yourself, it can only go up from here. But there is a fallacy rooted deeply in this thinking. The VIX really is structurally mean reverting, but not because of market psychology, but because implied volatility has a long-run statistical anchor and spikes are driven by exogenous shocks, not trend formation. If you closely observe the graph, you will notice that the low volatility environment that might seem like support to you is a place where the VIX actually likes to stay more than it doesn't. Bets on low volatility are in most cases historically better when they are preceded by low volatility. Also, the probability of a sudden, non-expected spike is already priced in the forwards, so any desire to long it off the support really doesn't make sense. We will get to this more later. The point is that the VIX lends itself to modeling probabilities rather than technical patterns. What may appear as support or resistance is often just a reflection of its natural tendency to stay within certain volatility regimes. Thinking in terms of probabilistic outcomes provides a much clearer and reliable framework than reading charts in the traditional sense. To not go too deep into statistics and probability distributions, I'll give you one very easy to understand example of how you can be sure if the VIX is going to go up the next day, and there is zero need of chart patterns for it. The VIX uses implied volatilities from a range of strikes around the 30-day expiration in S&P 500 options. The 30-day is not a loose rule. There is a window of 23 to 37 days for options to qualify for the calculation. If the 30th day is a holiday, and there are no expirations on that day, an expiration before and after it is taken, and the 30th day is extrapolated from them. But let's say the 30-day expiration exists, and there is a bump in the term structure in exactly 31 days. This could be due to an important announcement taking place that introduces uncertainty at that expiration. The current VIX won't reflect this as the date is currently out of the calculation, but after 1 day passes it will enter the calculation, as this will become the new 30-day expiration and the VIX will rise with it. You still might be thinking to yourself, what is this guy on about? I clearly see resistance and trends in the VIX. Well, let's say it simply. While it might look like a trend on the graph, it doesn't tell you anything useful because the VIX is not a price formed by buyers and sellers expressing directional views. I'll repeat what was mentioned at the beginning as it is an important point in all of this. The VIX is a mathematical calculation, and as such, it is not tradable. While there are derivative instruments on the VIX that are tradable, their pricing has all of this information already in it. This is why there is a futures curve, and why although you can be almost certain the VIX is going to mean revert, after spiking above 60, there is little possibility of actually trading this. Since it is mechanical and easily known, it is already priced in the forward. A good way to say it is that VIX charts are descriptive, not predictive. This is why you should leave technical analysis use to other instruments. With all of this in mind, you might gather your own conclusion on why it might also fail while graphing yields and other securities we mentioned at the beginning. If you are still interested, we might cover those in another one, so let us know.